So we're back. Now, as promised, last week I took some questions on my Instagram page and I said that I would pick out the ones that I'd feel that you gain most value from and I'd answer them here. So we have about 20 to 25 questions. So I hope you find the answers useful. So the first one is, how do you run these companies once you own them? So firstly, it's understanding what is the company strategy. You know, what is it that you're trying to do, where you're trying to go, and of course, how you're trying to get there. Secondly, it's piecing together the right team. So first, I want to know if we have the right people, especially at management level. And then lastly is giving the team the resources needed to execute on the vision. Now, some companies already have a good management team, some need work, but the management team really should be growing at least the same rate of growth as the company itself. And then if we look at internal development, that's absolutely key. Always try to push hard for simplicity. People do like to overcomplicate things, so be clear and concise, and it'll make your job easier. Because for me, leadership isn't so much about power, it's more about empowerment. And to grow a portfolio of companies, you definitely need vision, you need to be able to delegate, and you need to be very good at communicating with the right people. So the next one is, how do you get the most out of the team that you've inherited? So I've changed how we operate some of our companies quite recently. We changed from the typical org chart for an output chart. So now we assign outputs instead of job roles. So anyone is replaceable, but then the outputs aren't. So the idea and the process in general moves away from the dependency on people. So if someone, for instance, goes on holiday, then someone else just covers the output. So the business doesn't just stop working because a member of staff has gone on holiday. And you'd be surprised, with the amount of businesses that are solely dependent on one individual. This method has worked wonders for us. So the next one is, how do we overlook the risks of buying a business? So look, we can't wait for the conditions to be perfect. If we did, we'd never get anything done, and that's with pretty much everything. But every business typically suffers with the same three things: risk, scale, and liquidity. So the real question is, how do we solve those things when we own the company? Now, if you're buying a good business that's already profitable, already has a proven track record over many years, then at least you've somewhat a stable foundation to start with. So the risk should be pretty low. Then liquidity must be there to a certain extent, especially for them to be operating profitably for decades. And then, I suppose that's the benefit of you buying an existing business. Someone else has already put in those hard yards for decades. And then scale is another skill set in itself. So the next one, if I found a business that I wanted to buy right now, how would I fund the acquisition? Is there a form of acquisition mortgage like buying a house? So there's many creative deal structures, and we like to blend different methods, but a few options are debt finance, which is essentially a business loan, which would be similar to a mortgage in some ways. So this could be a cash flow loan, which is a loan based on the anticipated cash flows of the business. There's asset-based lending, which allows you to use the assets of that business as security for the loan. You could leverage the debtor book. Another option would be for you to acquire the existing debt that's already in the business. So, the business is already servicing that debt. So providing there's no change of control clause on that debt, it's most likely going to be cheaper than taking on any new debt to fund the acquisition. Then of course the seller finance, where the seller provides the financing for you. So when you blend these together and some other methods, you can put together some pretty creative deals. So next, what's the first thing you look at in a company to know if it's worth buying or has potential to grow? So there's a lot. Firstly, I think, what is the company's unfair advantage? And is there anything in particular that makes it unique in any way? I also look at talent gaps. You definitely need the right people in the right seats, especially if you want to get those outputs you desire. And also having long-term vision. Of course, we're all in a race to get to the finish line as quick as possible, and everything's become so instant, and long-term commitment isn't really interesting anymore, which really gives time a huge arbitrage opportunity. And the best is also, look, time's the best way to generate value. And the great thing about M&A is you're typically buying something that has generated its value over time, and usually in decades. But deciding potential, for me, it needs to fit into your existing ecosystem firstly, and I also need to know from the jump where the value creation is coming from. But really it needs to make sense for the individual. So it should ideally fit into your long-term vision. Next is, what is the perfect deal for you? The million-dollar question. Okay, so the perfect deal for me is probably a company that has high margins, a great self-sufficient management team, a company that hasn't adjusted prices for many years, doesn't already have full visibility of financials, has repeat customers, an element of recurring revenue, no revenue concentration, or if there is some, nothing too drastic, something that has a lot of upside potential in general, and also one that has an owner that wants to sell but probably isn't going to get what they want for the business if they sold today. But with a bit of work over the next 18 to 24 months, we can make some changes and then market the business for a premium. And I work with business owners on more of a consultant for equity approach, which is very much performance driven. So I usually try to work into about 33% of the company on sale, usually done through an equity option agreement and some other bits. And then make sure we add some legal bits in there to protect myself and the owner, and then we get to work. What are some of the red flags or things to look out for when buying a business? So this one depends on the business and the sector, but some of the things that would be red flags regardless are key person dependency, revenue concentration, low revenue per employee, high cost per hire, high customer acquisition cost, heavy capex. There's so many, but look, red flags, you can also look at those red flags as opportunities. Those red flags don't necessarily mean that you should walk away from a deal. It could actually be the place where you get some of the negotiation leverage from. Next, with the consultant for equity deals, how do you go about improving a company's margin? Okay, so it's a good question. But look, sometimes you have to get your head out the spreadsheet. Data-driven decision-making is important, but understanding process bottlenecks, underutilized resources, talent gaps, plus a ton of other things, you have to go out and get that information. The numbers do tell a story, but a lot of the time, not the whole story. How do you know if one of those consulting deals is worth the time that goes into them? Okay, so this question is based on a consultant for equity deal. So firstly, I would see if I personally have the time and resource available. Then looking at the target company, I'd probably look at how many people currently buy their product or service, how could I improve it, how much does it currently cost to deliver to the marketplace, and can I make that outcome more valuable, and also reduce the cost of fulfillment. That'd probably be a good place to start. Next is, property is such a good asset. Why did you stop investing in property and focus on buying businesses? So look, I've been bombarded with questions on this one. And this is my personal opinion on why I'm not actively looking to buy property. So for me, each property unit is an immobile, asset-heavy small business with customers that spend most of the day ruining the business. Now, depending on what road you go down, the outcome can vary, but there'll also still be challenges. But look, buying single units and just renting them out is a very unproductive use of time and money. Now, most people make decisions to try and better their circumstances, and I'm personally a big advocate for delayed gratification, but for me, this is not the way to do it. You have to buy cash flow. A couple £100 per month that gets eroded by maintenance costs, tenant voids, and everything else is just not a good business model in my opinion. So next, I've been investing in property in the north of England for the last 3 years using the BRR strategy. My income goal is 100,000 a year, currently at 8 properties with just over £1 million all investor funded, and they cash flow 2,800 a month. My passion is business, but I pay 10K for a course to learn BRR, so I'm hesitant to change. What would you do? Okay, so providing there's no unexpected costs and tenant voids, 2,800 a month, you're currently cash flowing around 33,000 a year. So you could either replicate what you've already done, raise some more funds, find another 16 units, and then in 6 years at the same rate you've been doing it, you'd be at your goal. But for me, if you already have passion for business, I wouldn't wait. There isn't a perfect time. Go and buy an existing business. It could be something that aligns with what you're doing now, maybe even a property management company. You'll definitely hit your 100,000 milestone much quicker. And then over a 6-year period, you could even have a group of those businesses. So if you think about the time, resource, and capital that's gone into building that portfolio of 8 rental units that you have now, and you put the same into business, there'd literally be no comparison. Now, for instance, looking at your current portfolio with all the costs associated with building it, you've probably raised around, I don't know, £1 million. Now, for that million, you have 8 units that are pretty much 100% leverage with refinances and investor funds. But of course, you do have those assets, which over time should appreciate. Now, if you raised £1 million to buy a business and you didn't use any additional debt to fund the deal, just a straight £1 million, you'd be buying something that probably does around £500,000 in profit per year for the same money. Now, on one side, you have a property portfolio that has produced 33,000 a year from that £1 million compared to one single business without any creativity whatsoever that gives you over £500,000 in cash flow. So over a 10x difference. Now, with the way we do things, you wouldn't need £1 million cash to buy a business that does £500,000 profit. And if it was me, I wouldn't wait, especially if that's the plan anyway. Next, so to make an offer to buy a business, what would you need to see first? So firstly, I need to see some of the historical financial data, so 3 to 5 years management accounts, an up-to-date P&L, balance sheet and sales ledger, an asset register if they have one, and then spend a bit of time analysing the current cash conversion cycle, look at their current payment terms, and of course understanding the motivation for sale and the director's age, what role the current owner or owners play in the day-to-day of the business, if any. I like to see an employee matrix, terms of the lease if there is one. It depends on the business and conversation I would have had up to now as well. Building solid rapport up until offer stage is super important because there'll always be key bits of data that you'll get from general conversation that you would have typically had with the seller. But that's a good place to start. Next, why do businesses that have been running for over 10 years fail? Okay, so there could be many reasons. Usually is a lack of capital or they failed to reinvest in growth. But businesses could start to decline because of various reasons, bad management or ownership in general. Maybe the product or service hasn't really been presented to the marketplace very well, or the quality has been compromised at some point. Maybe it's suppliers or customer issues that has led to the decline. Sometimes it can be just a bad economic climate or something the business just isn't equipped to absorb, But you do have to stay hunting as a business owner to continue the success. Next, why is working capital so important in acquisition and how do you improve it? So firstly, it's the life and blood of the business. Without it, there is no business. And to improve it, so if the business is leaking cash, remove all the unprofitable business, look at any resource heavy clients that have very small margins, improve the cash collection process, look at the current payment terms and try and build supplier relationships to try and extend those terms. Then you need to conduct a full review on sales pricing and also the current cost of product or the service the business provides. Plus, there are other things you could look at to bridge short-term gaps with like grants or R&D claims, but it's really making a list of all the quick wins and making decisions very quickly. If you're running out of cash in 60 to 90 days, just focus on low cost, high impact. How would someone with no experience do this should I go to college? All right, so I had no MBA, no investment bank or private equity experience, no business acumen whatsoever when I started. So, I left school at 16, went straight into work, failed miserably at a few startups, but I did learn a lot by wearing all the hats and, having that real world experience of running a business. That's pretty much my Main Street MBA. Since then, I've been involved in, directly or indirectly with over 30 acquisitions in many different creative deal structures across different countries. So this is more about educating yourself and finding out what you need to know, who you need to know. Make sure, you surround yourself with the right people. The right network alone can get you doing multiple deals and, have you exploring tons of different opportunities. So knowledge, network, and hard work is the magic formula. You always mention the importance of having a good team. So what makes a good team? Right, so firstly, you need to not only be able to retain talented individuals, but also be able to attract talent too. Also, internal development is so important. Developing leaders is very underrated. People focus on headhunting more than internal development. And look, both can be effective, but for me, developing internally is a complete game changer. It actually allows people with potential to flourish in the right environment. And, you can also see then which roles, have the greatest impact on the value creation, plus making sure that, you relentlessly drive focus and making sure everyone's aligned with the overall vision. It is very much a balancing act. Where is the best place for someone to start? All right, so firstly, you need to figure out what you want your life to look like, and then also what's going to get you that life. So, for instance, if you want a Rolls Royce, holiday homes, and fancy watches, then think about the career path that you're on right now and ask yourself if you're already working towards it. If not, then start writing down the things that can get you it. So if you're going to go down the typical education route, and I'll use the same example, there's only a few careers that can really get you that lifestyle, right? So if we take your typical CEO in the UK, and you can Google it if you want, the average CEO in the UK makes around 100,000 a year. In London is about 150,000. And then plus you're working a 70 to 80 hour week, right? It also takes on average about 25 years to become a CEO. And then the usual route to progression is waiting for someone to die or retire. So instead of waiting 25 years for someone to die or retire, you can save yourself the 25 years and those 80 hours a week just by buying a very small business that's also been around longer, that already has management structure, is already profitable. Yeah, I would start there. When you buy businesses in different industries, how do you figure out how to scale them? Okay, so firstly, it's having visibility of everything the business does. Financially, operationally, understanding the ability of management. But regardless of the sector, whatever product or service the business sells, is figuring out who the customer is and what do they want. Not all people have the same needs and desires. So what is the need and who is the buyer? What's the buying process? How do I segment the market? Who actually needs us and why? And then also, how do consumers become aware of that product or service? So just by running a general consumer analysis will definitely have significant impact on scale in general. But a lot of business owners pretty much operate in partially blind. How do I surround myself with the right people to achieve my goals? All right, so depending on what your goals are, firstly, find people that are already doing what you do. And then if you have to pay to get in those rooms, do it. Because really the only difference between you and the person that's at the next level is just the people that they know and the information they have access to. So yeah, I wouldn't really overcomplicate this one. And lastly, what are some of the issues you run into after you buy a business? All right, so the transition period is always interesting because it's change and new for everyone. So, that can come with some challenges. But the things that, can be difficult are old customers stuck on stale pricing, employees with special arrangements, assets that haven't been replaced for a long time, a management team that actually lacks leadership. Bad payment terms are quite common. But one of the main issues is usually the previous owner does a lot more than they said, which means everything is most likely going to take longer. So we've come to the end of the questions from last week's Instagram post. I'm actually going to try and run these on a more frequent basis. So feel free to DM me any questions you think would be useful for me to give answers to, especially on this channel, something you may want to watch back or you feel that someone else may take some value from. So until next time,